Hello, my name's David Paradice from Paradice Investment Management. I have with me Kevin Beck and Paul Mason. They run our global small to mid-cap fund based out of Denver. They're currently approaching $900 million in funds under management. As of the 1st of August 2014, they will have been going for 4 years. The annualised performance has been 19%, so they're doing a fantastic job, and it's showing that the business model and as stock pickers, they're working very well. So can that performance continue? Are you finding opportunities?
Yeah, David. As you said, we had a very strong year last year as economies recovered in the US and in Europe. And so as you remember, we're a 50 stock plus portfolio. So we have many opportunities in a big universe of 14,000 stocks. And so today, despite the strong outperformance, we continue to find opportunities in places like the US, in the UK, and specifically in emerging markets. And so emerging markets has been an area of the market over the last 6 or 8 months because of tapering in the US that's shown a lot of stress. And as you know, we're company specific, so we don't have a contiguous view on emerging markets, but we are finding one-off opportunities in places like Korea, in Indonesia, in Singapore, for example. We own a food group in South Africa. And so some of our best performers actually over the last 6 to 8 months have been in places like emerging markets, which has seen a lot of negative noise and returns over the last few years.
Yeah. So the opportunity, because of the downturn in those markets, has created opportunities. Paul, you got a few stocks?
Sure. I mean, we think last year in emerging markets, there was such negativity around, and ETF outflows were at record highs. And with ETF outflows, you just see selling across the entire spectrum of companies. We don't believe the issues that EM may have going forward is going to affect everything. So I guess, for example, there's a listed company in Singapore, which is not EM itself, but all its growth is coming from emerging markets. Now, this company is very similar to a Baker's Delight or a Brumby's, and it's growing and investing aggressively across Southeast Asia. We're seeing the headline growth. Right now, the margin's still depressed as it is investing heavily, but over time, we see that business with significant upside.
So one of the big focuses of the business as a group and also your fund is the capital preservation. So I suppose these opportunities provide some of these stocks which are quite cheap. So what kind of multiples are you paying, or are you still paying the cheap ones that you used to pay?
Yeah, we continue to pay 6 to 8 times normalized operating profits for the businesses that we own. And as you know, we don't like businesses with debt, so you put a lot of leverage on small companies, and you tend to get really strong returns in good years and very bad returns in tough years. And so we're trying to compound at these 15 to 20% rates of return, pay the same multiples, and we still do find businesses at the same multiples we've been paying for 4 years. And again, if we're right, we compound at great rates, which we've been able to do for the last 4 years. But if we're wrong, we continue to move the ball forward with businesses with high dividend yields and good returns.
And so I suppose the portfolio is, say, 50 odd stocks. And I know that over the last couple of years you've had a number of buyouts because the valuations that you're paying are also appropriate to people that want to privatise those particular companies. So maybe you might want to talk about some of those.
Yeah, I mean, we've had approximately 10 buyouts over the last 3.5 years, which I think, and if you look at the actual names within that, they're all across very different industries and very different geographies. So we are generalists at heart, and we think we have an ability to find good companies that are cheap, that maybe private equity wants to buy them and leverage them up and get a strong return, or occasionally they're just strategic corporate buyers. And we're playing in that sort of 1 to 2 billion sweet spot in market cap, where either companies are dominating a small industry or they're starting to take share off the big guys. And in a global economy where interest rates are at 3% for corporates, it's cheaper to buy than it is to build. So we think as markets continue to be strong, that M&A will be a recurring theme, and we all know that US corporates are cashed up, and they'll continue to be buying smaller companies.
That's great. It's fantastic. It's when we're trying to find opportunities in Australia, it's been really difficult for us, and because a lot of people are competing for just a small number of stocks, whereas it's totally the reverse. There's not much money chasing a lot of stocks globally. So thanks very much.
Sure.
Thank you.